In 1998, a young internet founder stepped into the spotlight and watched Wall Street lose its mind. His company had no empire, no massive profits, no proven future. But on its first day as a public stock, the shares exploded more than 600%. Overnight, Stephen Paterno became a symbol of a new age. Money was no longer patient. Investors no longer wanted proof. They wanted a dream with .com attached to the end. And for one brief moment, the dream looked unstoppable. Then he said the kind of sentence that made the whole era look insane. He bragged about having the girl, having the money, and being ready to live a disgusting and frivolous life. It sounded like a joke. It sounded like arrogance. But more importantly, it sounded like a warning. Because when people with no profit start talking like kings, the market is no longer pricing businesses. It is pricing fantasy. And fantasy can rise faster than logic can stop it. 6 months later, the glamour had started to rot. Stocks that had been treated like tickets to the future suddenly looked like lottery slips from yesterday. Shares that once screamed upward began collapsing toward pennies. But Paterno was not the disease. He was the symptom. The real madness was bigger than one founder, one party, or one arrogant quote. The real madness was that an entire financial system had started rewarding companies for losing money faster. By the late 1990s, Wall Street had discovered a new religion. The internet. Every generation gets one phrase that makes people forget risk. During the dot-com bubble, that phrase was, "This time is different." Profit did not matter. Cash flow did not matter. A business model barely mattered. If a company had a website, a strange name, and a promise to change the world, investors believed it might become the next Microsoft. The question nobody wanted to ask was simple. Change the world into what? The old rules were not just ignored. They were mocked. Price-to-earnings ratios became boring. Balance sheets became old-fashioned. Profitability became suspicious. Some bankers openly suggested that being profitable could actually hurt a startup's valuation, because profitable companies were judged like normal businesses. Internet companies were different. They were judged on eyeballs, clicks, traffic, page views, and future domination. It was not finance anymore. It was storytelling with a stock ticker attached. The logic sounded clever at first. The internet was new. Scale mattered. Winners could grow fast. If a company captured users early, maybe profits could come later. That idea was not completely stupid. Some internet companies really would become giants. But the bubble twisted a reasonable insight into a dangerous cult. It took the phrase "profits later" and quietly removed the word "profits." Suddenly, losing money was not a weakness. It was a growth strategy. Pets.com became the perfect symbol because everyone could understand the absurdity. It sold pet supplies online. That sounded futuristic. The mascot was memorable. The advertising was everywhere. But underneath the puppet was brutal math. The company was shipping heavy bags of dog food across the country, often spending more to deliver the product than it could make from selling it. Every order looked like growth on a chart. Every order also dug the hole deeper. That was the strange genius of the bubble. Bad economics could hide behind exciting language. A company did not lose money. It invested in customer acquisition. It did not burn cash. It scaled aggressively. It did not lack a plan. It was building market share. The words made failure sound strategic. And once investors accepted the language, almost anything could be justified. If losses were proof of ambition, then the worst businesses could look like the boldest ones. The venture capital machine poured fuel on the fire. Startups were told to grow fast or die, hire faster, advertise harder, spend before competitors could catch you. Founders were no longer building careful companies. They were racing to become monopolies before anyone asked whether the business worked. The money was so abundant that discipline began to look like weakness. In normal markets, cash is oxygen. In the bubble, cash became gasoline. And then came the marketing wars. Dot-com companies bought television ads, billboards, stadium sponsorships, and Super Bowl commercials with money they had not earned. The goal was not efficiency. It was awareness. Be seen, be remembered, be everywhere before the next company stole the dream. Some ads became famous, some became jokes, but every commercial had the same hidden message. Please believe in us long enough for the stock market to keep funding us. The public wanted in. Ordinary people who had never studied business started day trading from bedrooms, offices, and kitchens. Online brokerages made the market feel like a video game. Stocks became conversation pieces. Neighbors bragged. Taxi drivers had tips. Employees watched tickers during work. Every rising chart taught the same lesson. Patience was for fools, risk was for cowards, and the internet had created a shortcut to wealth. The trap was that shortcuts work beautifully until the road disappears. By 1999, the NASDAQ was flying. The technology index had doubled that year, and every new high made skepticism looked stupid. People who warned about valuation were treated like they did not understand the future. That is how bubbles protect themselves. They do not defeat critics with logic. They defeat them with price action. As long as prices rise, the bubble looks right. The danger is that rising prices do not prove the story is true. They only prove people are buying. Inside companies, the pressure became insane. Founders who should have been building operations were suddenly managing press tours, investor calls, public expectations, and celebrity status. A company could be young, fragile, and unprofitable, but its stock price could make the founder look like a genius. That kind of fame is dangerous because it arrives before the business is tested. It teaches entrepreneurs that the market's applause is the same thing as proof. It is not. Behind the scenes, insiders started acting differently from the crowd. Publicly, the dream was infinite. Privately, many executives and early investors understood that the valuations had detached from reality. In the month before the peak, corporate insiders were reportedly selling far more shares than they were buying. The public was being told to hold on. The people closest to the companies were heading for the exits. That is not a footnote. That is the smell of smoke. The contradiction was everywhere. Analysts on television praised companies that insiders were selling. Investment banks promoted stocks from companies they wanted as clients. Media outlets treated young founders like prophets. Retail investors believed they were joining the future, not buying from someone else who wanted out. That is how mania works. Everyone thinks they are early. But in the final stage of a bubble, the insiders are early. The public is liquidity. On March 10th, 2000, the NASDAQ reached its peak above 5,000. It was the highest technology had ever flown. For believers, it felt like confirmation. For skeptics, it looked like a cliff disguised as a summit. But crashes do not usually announce themselves with thunder. They begin with small doubts. A funding window tightens. A news report shifts sentiment. A few stocks break. Then the market starts asking questions it refused to ask on the way up. The first drops did not feel like the end. That is what makes bubbles so cruel. When a stock falls 10% after rising 500%, believers call it a discount. When it falls 30%, they call it volatility. When it falls 50%, they call it a buying opportunity. By the time it falls 90%, the investor is no longer analyzing. He is praying. The market had moved from greed to denial. Then the funding machine jammed. Startups that had built their entire strategy around raising the next round suddenly discovered that the next round might not come. Payroll still existed. Rent still existed. Servers still cost money. Advertising contracts still had to be paid. But investor enthusiasm, the only thing keeping many companies alive, began evaporating. These businesses had not been built to survive. They had been built to be funded. Pets.com collapsed fast because there was no margin of safety. The mascot could not pay suppliers. The brand awareness could not fix shipping economics. The Super Bowl ad could not turn negative unit economics into profit. Within months of going public, the company was gone. It became a punchline, but it should have been treated as evidence. The market had funded businesses that were not just early, they were structurally broken. Webvan was even more terrifying because it looked ambitious in a respectable way. Online grocery delivery, huge warehouses, fast logistics, a vision of the future. But the company expanded before it had proven the economics. It built expensive infrastructure, entered multiple markets, and burned through capital at a speed that made survival almost impossible. The idea was not crazy. The timing, spending, and execution were. Sometimes being right about the future is not enough if you arrive with the wrong cost structure. That is one of the hidden lessons of the dot-com crash. Many ideas that failed in 2000 later worked in different forms. Online shopping worked, digital advertising worked, cloud software worked, streaming worked, online marketplaces worked. But markets do not reward ideas alone. They reward timing, execution, capital discipline, and business models that can survive long enough to become true. The bubble was not wrong about the internet. It was wrong about price. The crash exposed a brutal difference between technology and stocks. A technology can change the world while the stocks tied to it still destroy investors. Railroads changed the world. Many railroad investors lost money. The internet changed the world. Many .com investors were wiped out. A revolutionary industry does not automatically make every company valuable. In fact, revolutions often attract too much capital, too many competitors, and too many bad promises. As stocks collapsed, employees discovered that paper wealth was not the same as wealth. Options that looked life-changing became worthless. Startups that promised freedom started firing people by the thousands. Office furniture was auctioned, servers were sold, launch parties turned into liquidation sales. The dream had been measured in market capitalization. The aftermath was measured in rent, severance, debt, and resumes sent into a suddenly crowded job market. Retail investors suffered differently. Many had believed they were participating in history. Some used savings. Some used margin. Some confused a bull market with personal skill. The rising market had made everyone feel smarter. The falling market revealed who had been swimming without risk management. When the NASDAQ kept sliding, the emotional damage was not just financial. People felt betrayed by the future itself. The NASDAQ eventually lost nearly 80% from its peak. That number is hard to feel until you translate it into human behavior. A stock needs a massive gain just to recover from a huge loss. A portfolio down 70 or 80% does not simply need patience. It needs years, new capital, and emotional survival. Many investors did not wait for recovery. They sold after the damage was done and never came back. The broader economy felt the shock. Venture funding dried up. IPOs slowed. Technology workers lost jobs. Office markets in tech hubs weakened. Advertising budgets got cut. Suppliers felt the pain. The bubble had created an ecosystem of spending, and when the money stopped, the ecosystem contracted fast. This is why bubbles are never contained to stock charts. A financial fantasy can hire real people, lease real buildings, and leave real wreckage behind. And yet, something strange happened in the ruins. The internet did not disappear. The weak companies disappeared. The strongest survivors learned the lesson others paid for. Amazon had crashed too, but it survived because it had customers, execution, leadership, and a path that became more convincing over time. The crash did not prove the internet was fake. It proved that the market had paid any price for it. That distinction changed everything. The survivors became more disciplined because the market forced them to be. Cash mattered again. Profit paths mattered again. Customer value mattered again. The crash returned a word that had been erased. Fundamentals. It was not glamorous. It did not make founders look like rock stars, but it separated companies that could endure from companies that only existed because investors kept wiring money. Reality had not changed. It had only been ignored. The uncomfortable truth is that bubbles do not happen because everyone is stupid. They happen because a real trend meets easy money, social proof, greed, and a story big enough to silence doubt. The internet was real. The opportunity was real. The productivity shift was real. But valuation is the bridge between a good idea and a good investment. During the bubble, that bridge was replaced by a rocket. Rockets are exciting. Bridges are safer. This is why the phrase, "this time is different," is so dangerous. Sometimes the technology is different. Sometimes the market structure is different. Sometimes the opportunity is different. But human nature is usually the same. People still chase what has gone up. They still envy quick wealth. They still confuse confidence with competence. They still believe they will sell before everyone else. The technology changes. The psychology repeats. The dot-com crash also exposed the danger of outsourced thinking. Many investors did not understand what they owned. They trusted analysts. They trusted headlines. They trusted price movement. They trusted the crowd. But when the crowd turned, nobody had a real thesis to hold on to. A stock without understanding becomes a panic button. The moment it drops, the investor has no anchor, only emotion. Insiders understood incentives better. Founders could raise money. Bankers could collect fees. Venture capitalists could mark up investments. Media companies could sell attention. Advertisers could sell campaigns. Everyone had a reason to keep the machine running. That does not mean every person was corrupt. It means the system rewarded optimism at exactly the moment skepticism was needed most. When everyone gets paid by belief, disbelief becomes expensive. The public learned the lesson last because the public usually sees the dream after it has already been packaged. By the time a company is on magazine covers, Super Bowl ads, talk shows, and brokerage screens, the early money may already be looking for an exit. That is not always true, but during mania it becomes a pattern. The story arrives polished, the risk arrives hidden, the bill arrives later. After the crash, people wanted villains, greedy founders, reckless bankers, naive investors, hyped analysts, and yes, all of those existed. But the deeper villain was a collective refusal to count properly, count revenue, count losses, count dilution, count cash burn, count the cost of acquiring customers, count the time needed to become profitable. The bubble was not destroyed by pessimism, it was destroyed by arithmetic. For business builders, the lesson is brutal. Growth is not automatically good. Growth that makes every sale more unprofitable is a trap. Marketing that creates awareness without retention is a leak. Fundraising that delays discipline can become poison. A company can look bigger while becoming weaker. In the dot-com era, many startups did not scale a business. They scaled a mistake. For investors, the lesson is even sharper. A revolutionary theme is not enough. You need price, quality, durability, and a path to cash generation. If the only reason to buy is that someone else might pay more later, you are not investing in a business. You are renting a belief. And when belief changes landlords, the rent comes due immediately. That is what happened when dot-com confidence finally broke. The scariest part is that the dot-com bubble was not just a historical event. It became a template. New technology appears, early winners become legends, capital floods in, language changes, skeptics get mocked, metrics get reinvented, insiders sell, retail arrives late, then reality asks for cash flow, the costumes change, the play stays familiar. That is why studying the crash matters now. 25 years later, the warning signs still matter. Not because every exciting technology is a bubble. That would be lazy. Some technologies truly change the world. The warning is that world-changing technology can still be overpriced, overfunded, overhyped, and surrounded by companies that never deserve the valuations they receive. The question is not, is the future real? The question is, what price are people paying for the future? That is the uncomfortable truth about the dot-com crash. It was not a simple story of fools chasing fake companies. It was a story of real innovation wrapped in financial insanity. The internet survived, many investors did not. The dream survived. Many businesses did not. The future arrived, but not on the timeline, price, or profit assumptions that Wall Street sold to the public in 1999. The dot-com bubble crashed because investors forgot the difference between a great story and a great business. A story can raise money, a story can sell ads, a story can push a stock to impossible heights, but eventually a business has to produce cash, satisfy customers, survive competition, and justify its price. When the story met arithmetic, $5 trillion vanished, and the real question is not how people believed it then. The real question is what story people are overpaying for now. Thanks for watching. Like, comment, and subscribe. If you enjoyed the story of the dot-com bubble, how it all crashed, then you'll love the story of how BlackBerry went from owning the world to almost disappearing. Click the video on your screen now. I'll see you there.